Hi, and welcome back to Heimler's History Economics Edition. We've been talking about money in the last few videos, where it comes from and how we measure it. And in this video, we're going to talk about the role of banks in the creation of money, so let's get to it. Okay, so banks. In another video, I explained how banks are a financial intermediary in our economy. And the role of banks is to provide liquid assets to borrowers who want to invest them in illiquid assets. Which, being translated, means that banks loan out money to people and firms who want to buy stuff and invest in stuff. Now, a bank can't loan out all the cash that depositors put into it because they have to have some cash on hand when the depositors come back asking for their money. So the money that stays in the bank is called its reserves, or its bank reserves. And since the bank holds on to some of its deposits and then loans out the rest, in a very real way, banks create money. Now, when I say banks create money, I don't mean they have like a room in the back where they're printing off 10s and 20s. But they create money nonetheless. Now, how is that? Well, let me introduce you to a simple tool that can help you understand it. It's called the TAccount. It's graph time, except it's more of a chart than a graph. So a TAccount is used to show the assets and the liabilities for businesses and banks. So a basic TAccount for a cheese sculpting business might look like this. Let's say the business owns a building valued at $50,000, and they own cheese sculpting tools valued at $15,000. Those two would be considered its assets. But let's say that to finance the purchase of that building, the company had to borrow $30,000 to build it. That goes over here in the liability side because they have to pay that money back. Okay, easy enough. Now let's look at a TAccount for a bank. In the bank's asset category is all the loans they have made. And let's say it's in the amount of $1 million. In addition, in its assets category are all of its reserves. Let's say $100,000. Now the bank's liabilities are on the right, and that would include all of its deposits. Let's say $1 million in deposits. Now, the reason why deposits are considered liabilities is because the bank owes that money to its depositors should those depositors show up and ask to withdraw it. Okay, now that we've got this tool in our belts, let's see how banks create money. Let's say that you go to a bank and deposit $1,000. When that happens, the bank's total amount of checkable deposits increases by $1,000, and that's easy enough to see. But so far, no money has been created. So let's say the bank holds on to 10% of that money, and that 10% constitutes its reserves. So that means the bank is going to hold on to $100 and then loan out the other $900. So now there's $100 left in the bank deposits, and since I now have a $900 loan, there is now $900 more in the economy. So let's say I'm throwing a party and I need a nice cheese sculpture, so I go over to the old Cheddar Chapel and they make me up something real nice. So I give them my $900 for a cheese sculpture. And then let's just say they take that money to the bank and deposit $900 into the bank. Now, since the bank is going to keep 10% of its reserves, that means the bank is going to keep $90 and then loan out the other $810. So watch what happened. From that initial $1,000 that was put into a bank, they loaned out $900 and put that $900 into the economy. That $900 went to the Cheddar Chapel. They put it in the bank, and the bank loaned out an additional $810. So if you add the $1,000 to the $900 to the $800 that was put into the economy, you get $2,710 put into the economy from this original input. Now, when economists want to talk about the way money multiplies in this way, they talk about the money multiplier. Now, we're using a very simplified model here. We're assuming that all the money that comes into a bank, they hold on to the reserves and then loan all the rest out, and then it comes into another bank and they hold on to their reserves and loan all the rest out. Now, in the real world, it's more complicated than that. Sometimes people hold on to the money that they're loaned, and that will make the multiplier smaller. But just for simplicity and to learn the concept of the multiplier, let's just assume that every loan that a bank gives out is then taken and redeposited in another bank. So in order to see just how much money a bank can create from a single deposit, we need a formula, and I've got one for you. The amount of money that can be multiplied by a single deposit is that deposit divided by the reserve ratio. And just to remind you, the reserve ratio is just the amount of money that the bank is required by the government to keep in its vaults. So to go back to our previous example, if you deposit $1,000 and the reserve ratio is 10%, then our formula looks like this. And if you get these into manageable numbers, then you have 1,000 divided by 0.1, which equals $10,000. $1,000. So by putting $1,000 into the bank then turns that into $10,000 in the economy. Now, as I said, the determination of the money supply in reality is actually much more complex. In reality, the Federal Reserve controls the monetary base, which just accounts for all the currency in circulation and the reserves held by banks. Now be careful here, there is a difference between the monetary base and the money supply. The monetary base, as I said, is the sum of bank reserves and currency in circulation. The money supply, by contrast, is the sum of currency in circulation and checkable bank deposits. So now at long last, with all of those definitions tucked safely in our brain folds, we can define the money multiplier. The money multiplier is the ratio of the money supply to the monetary base. What the money multiplier tells us is the total number of dollars created in the banking system by each dollar added to the monetary base. And so the formula for the money multiplier is 1 divided by the reserve requirement. So if the reserve requirement is 10% or 0.1, then the money multiplier is 1 divided by 0.1, which equals 10. So the money multiplier in this case is 10. So that means if the Federal Reserve adds $100 to the monetary base, it will turn into $1,000 because 1,000 times the multiplier, which is 10, equals $1,000. And that, my friends, is all you need to know about the money multiplier. I'll see you next time. Thanks for watching another economics video. If this video multiplied your understanding of how banks create money, then hit the like button and multiply its influence. And if you'd like to join our little community of beard enthusiasts here at Heimler's History, then hit that subscribe button and come along. I'll see you next time.